So anyway, this should be an interesting session for most of you who are setting up your own restaurants, looking to expand, because one of the key things that you look for when you're looking for either to start your business, but especially to expand, is the investment in the business through private equity, through angel investment, through high net worth individuals. I think any source of funding is very important as you look to expand your business across your city, state, India, international. And I think the purpose of this session is to give you a bit of a flavor of what investors. I've got 3 investors here and 1 investee, so you will get a slightly balanced view of what they look for when they are investing, and what should they be. What should you guys, as you look to expand your businesses, what should you be looking at and targeting, because at the end of the day, if they're going to come and put money into your business, if they're going to invest in your business for growth, they need to see a future prospects. They need to look at various aspects of it, the management team, the quality of execution, how scalable the model is, how much of technology there is, etc., etc. So I'm not going to take anybody's thunder here. I just leave it. I'm just going to open up the discussion. So I'll just go from left to right and just get all the panelists to just comment on the first part, that when they are looking to make an investment in the food services businesses, what is it that they specifically look for? And guys, just take a couple of minutes, just talk through that. So Pramod, why don't you start?
So first and the foremost is the proof of concept, the consumer skew and the financials. And alongside with this is the capability build up which has already happened in case the business has begun and has come into operations. Then the scalability potential to establish the brand. It should not happen that you're investing into a concept which can just not scale up, and it is something which is very artisan. So the establishing of brand would not happen from an artisan brand which sits just across one corner of the country. Third would be a governance in front end and back end operations of the company, which are as important, and what all has been done towards the same. The supply chain management and logistics. Besides that, the regulatory environments around the business, the FSSAI and the other things which have recently come onto the board. So one can imagine the regulatory environments also go hand in glove in terms of analyzing that business. And then the synergies, which some of the private equity companies or the funds who have already invested into the F&B businesses, they do analyze the synergies from their ecosystem if they have invested into companies which could draw the benefits by establishing some economies of intellect, infrastructure, as well as capital to be brought across to the table to help the business grow. So these are fundamentally a couple of things, which come to my mind. And I would pass on the mic.
Sure, Hemendra, so just give your view on, I think some of the stuff he's mentioned is absolutely spot on, the supply chain, back end, the whole piece around, assurance, how well it is maintained, but just your thoughts on all of these points and anything you can add.
So when we evaluate a food services business, there are 2 parts to it. We evaluate some of the financial parameters and some of the non-financial parameters. On financial parameters, I think, one thing which we really like is, higher share of home delivery. We strongly believe that, higher the share of home delivery, better is the economics, because the cost of delivery is usually less than the rental cost plus the cost of servicing on site. So, we love business models where the share of delivery is like 30-40% of the total revenue. I think that's really good. If it is more, even better. So that's one. Secondly, we also, look at the margins. So, of course, there are various models have various margins, but we look at models where the gross margins, as in the revenue minus cost of goods sold, is upwards of 60%. That's important. And EBITDA margin, ideally upwards of 20% at the corporate level, if not at corporate level, at least at the store level. I think these are very healthy numbers that we look out for. Third, we look at, which is, important, but not many people realize it, is what is the attrition rate. It's a very people-centric business, and, we have seen businesses where like 20% of the employees leave every year. It's so challenging for a food services brand, and I'm sure entrepreneurs sitting in the room would agree with that. It's not easy to train them, retain them, incentivize them. So we really monitor that, 5-10% is normal, but beyond that is pretty challenging. So this is on the financial side. On the non-financial side, as Pramod has already said, the focus on backend, and there are various components to backend. Your ability to develop vendors, your ability to manage central kitchen, your ability to sort of manage ERP, all these things. I think they become very important. I think the real value lies in the backend. And then we also look at the flexibility of the brand. I think this is becoming even more important in today's environment when the models are changing very quickly. Is the brand adaptable to multiple locations? Let's say a high street, a mall, a college canteen, a corporate office, a metro station. How flexible is the brand in adapting to various locations? So these are sort of some of the parameters that we look at, and I'll pass it on to.
Some great thoughts there. So all around home delivery, building up, flexibility of operations. Also looking at, obviously the financials are very, very critical. But I think some of these are important elements to think about because home delivery ties in very nicely into last mile costs. Also helps you sweat your asset more, so you get more and more people. You're able to reach out to your customers rather than wait for them to walk in. So some great thoughts there, Rahul. Raghav, I'll come to you in the end from a different perspective. But Rahul, what about you?
I think Pramod and Himendra have put out such a laundry list that I wish it was possible to get a company like that anywhere on this planet. So for me, top 3 things that, I would prioritize from all that one would wish for. One would be the clarity of position in the value chain. You should know exactly what you want to do, who is your target audience, and then the second aspect of it is how you're going to execute that. Because, it's all and well to make tons and tons of Excel sheets. And even having your position and strategy, articulated, it's quite common. You have quite a few companies who do that, but where they falter is in the execution. So proof of execution in the past is a key determinant for an investing decision. And third, it's a softer aspect, but I think it's the top 3 for me, is how you can actually, what is your take on the promoter?
Sorry?
What is your take on the promoter? Do you think he or she is a person who will be receptive to newer ideas, who will be receptive to professionalizing the institution if it's not already, which is usually the case? And would it be somebody who will be, okay with having somebody else on board and will be willing to, share in equity gains or losses of the company?
And for the 3 of you, when you're looking to invest in any restaurant business, do you guys look at taking a minority stake? What percentages? Because to your point, promoters will also will push back on some of those things. Say, I want to still run it. I still want the investment, but I want to call the shots. So at what point does that change, and what numbers Pramod starting, or maybe Rahul starting with you, and then just.
Well, it's different for each fund. I know Everstone takes, controlling stakes. We ourselves are minority investors, so we would rely on, the promoters to run the business. And
does that work? If you take a minority stake, is the promoter still willing to engage heavily and learn from you and say, okay, I've got your money, stay out of the door, I'll call you when I need you?
Yeah. And that is why getting that, softer feel on the promoter is important for us. And maybe that's why, Pramod didn't mention it as, one of the top 3 items for him.
Okay. And what about you, Hemendra? Just quickly on this point, and then I'll come to Raghav.
And absolutely, I think Rahul is correct. You have to believe in the promoter before you believe in the business. If you can't work with him for 5-7 years, forget it. And the challenge is always in the issue of alignment. Are you aligned? If the only option is to do a strategic sale, then I think it has to be discussed right up front. Like if we have invested in a restaurant business, we have 30%, promoter 70%. He knows how to run a restaurant, we don't know. So we don't interfere on a day-to-day basis. But how to prepare him for a sell? He also wants to sell his 70% when we are selling a 30%. I think that is critical, to teach him the importance of corporate governance, the importance of a good auditor, a good CFO, a good ERP, giving him benchmarks from competition, what should your bill size be, what should your transaction values, etc., etc. I think that is the role you can play. You can bring the processes, process orientation in the promoter. They're so passionate about the brand, the food, and the cuisine, and the recipes. So you have to sort of pull him out a little bit out of that. Look, this is not all you need to to sell the business. There's more to business. So I think that's the difference.
Promote quickly from you as well on this.
I would say that many of the promoters in this room would be sitting whom we have funded, and maybe we would have taken majority or controlling stakes out there. And that's a universal truth which goes into the environment, that you got to basically have a trust and faith in the owners who are managing that business, and potentially have a synergistic value alongside with them driving the business. The objective of us taking controlling stakes in many of the businesses that we are present in is largely because of scale reasons. If you need $500 million to be invested into the business to be able to scale up, now that sort of a capital may be scarce, and you may have to go to Series B, Series C, instead of going in for that and always having an X on your head to basically collect funds from the market. The funds are readily available, and hence the controlling stake concept comes in, wherein you are funding the business day in and day out as the needs may be, whether it's $500 million or $1 billion, just go ahead, invest it and make the scale come up. But the belief is still in the owner, that the owner is driving it. Besides that, as a fund, what we have strategically done is that we have done a capability build up within our own systems. So if you look at our teams, they are as well equipped as many of the F&B sectorial approach, so that we are able to guide the companies in the direction of growth and prosperity. So that is predominantly the difference. I would say the one major difference is scale. When we are looking at businesses, we are looking at a large scale, a large investment, to make sure that the country India can basically be done full justice to.
Thanks. Now, Raghav, you're the recipient of the investments, or a potential recipient of more investments. So, what do you look for? I mean, one of the things Hemendra mentioned was the ecosystem, bringing in the whole ecosystem with them, whether it's supply chain, expertise in other areas. It could be restaurant design, recipe design, back end, front end. So, what are some of the top 4 or 5 things that you would look at as an investee company?
Sure. So just as a background, we've raised since we started off in 2012, we've raised 2 rounds of funding. We raised an angel round early on, and we recently raised the Series A. So over and above anything else, I think it is that connect that you can make with an investor that is the most important thing. When you are an entrepreneur, you have a extremely large vision, and you want an investor who comes on board to be a partner, to be able to connect with you on that vision and have the aggression that you have.
Do you look for things like what Pramod mentioned, that they are a very well-equipped team that comes and lays out the systems for you? Or do you think that, I know what I'm doing, I love your passion, love the connect?
So I think primarily, I would say the first thing is that connect and that belief in the vision. Someone introduced me to this concept once, that all money is not the same. There is smart money and there is dumb money. So, when you talk about smart money, it is how much value you can derive from that same amount of money, which can come from a lot of things. It can come from a lot of learnings. It can come from connections. It can come from the guidance that comes from experience. So all of that, and at the same time, I think one very important factor is being able to have that independence to run your business, and that trust from the investor. I think that's very important at the end of the day.
Thanks. So Rahul, I think this time I want to start from you on that side, so that you get the first round. In terms of today we are just living in this era of valuations. Every day you pick up the newspaper and some company's valuation has gone 5x, 6x. What's happening in the food business? Do you see similar kind of valuations, or is it a difficult time right now? And if you to look out 1 or 2 years out, and that's probably as long a horizon, I can look at this stage, what would you think will the valuations be? So 2 sides, what is it today, and what should be? Are you think it's undervalued, overvalued today? And secondly, where do you think valuations will be in the next 1 or 2 years, without giving away too much?
All right. So you're investing in the food service sector is part of the whole investing in the domestic consumption theme. Is part of a larger theme. And as one particular avenue to invest in that theme, it's received the maximum amount of attention thus far. In fact, there have been almost 50 investments in this space in the last 8 to 10 years. Almost $500 million plus has gone into that. Valuations are still there, but there's a definite India premium for sure. Just to give you some statistics, in India, from whatever publicly available information was there, in about 30 odd deals in the last 5 to 6 years. Most companies on average, there's a wide range, but valuations have been about 3x EV to revenue, enterprise value to revenue. And that's pretty impressive compared to what companies have commanded globally. Listed companies, and I was just looking at a list of 87 listed companies internationally, are quoting at, and these are very good companies, mind you, are quoting at an average valuation of about 1 times EV to sales.
That's a big,
Yes.
so significant premium from India's perspective.
Yes, and on a EV to EBITDA basis, they're at about 9.8 times on average. PE investments and strategic investments in the food service space internationally, and I have data for the last 4 years comprising of about 40 such investments. That's about also 1 time EV to revenue and about 9.1 time EV to EBITDA. In India, you typically, you wouldn't bat an eyelid if you saw a deal at 18, 20 EV to EBITDA also, right? 18 is par for the course, really. What question is, what do you see in future? I think investors are becoming more discerning because there are, a few dead bodies over the past few years. So what you'll see is that there'll be possibly a winner takes all kind of a scenario. So for a good guy, like, we saw several of those good guys today in the morning, those benchmarks will be maintained and they might even improve. And for the number 3 or 4, there might be no investor at all.
Oh, really? So you see that level of sort of consolidation of revenues at the top. And I mean, your view on this, and is that because it's such a tough business that the top 2 really stand out? And just comment on the P word as well, profit. Does anybody care about that, or is it just...
Yes, we do. No, we do. We are basically a food supply chain investor. Most out of 9 investments that we have made so far, 7 are in the supply chain, where the multiples that we have paid is more like 6 to 9 EV EBITDA. And when we look at the restaurant deal, they ask for revenue multiple, and we really become nervous, So we always think in terms of EBITDA multiples at most, if not price earning. So I think there has to be discipline. I must say it's not easy to enter at 20 times EV EBITDA and make 25% IRR. That too on dollar. It's scary. So I think there has to be some discipline. Clearly, there are very few good entrepreneurs like Raghav. There's a scarcity premium. There are innovations, there are disruptions happening in the model which is commanding huge premium. But my guess is there has to be some more discipline when it comes to entry valuations. Even if the brand is great, model is great, you have to put a cap beyond which you don't want to go.
Pramod?
So, my take on this is this industry is virtually spread in 3 segments. One is the food services, which is what we are discussing out here. The second is the food tech, which is the e-commerce sector where you have Zomato's of the world sitting out there. And third is the food manufacturing, which is the third sector.
The third one is?
The food manufacturing.
Okay.
So, which is the processed food and so on and so forth, which is also coming into vogue. So, if you look at the food services today, it's trading in EV EBITDA on early teens in the country. So early teens is where, most of the deals are happening. And most of them are, in the winning stride of the deal. The moment you cross that 18 to 20, you are basically spreading yourselves on literally some magic happening into the country. And, those achhe din which never came in are something that, you're treading your bells on. So theoretically, when you look at a consumer story unfolding into the country, and if you're talking about early teens being the EV EBITDA value being paid for, this is well worth the bet, because the consumer story which has got to unfold into this country into the next decade is going to be really very, very exciting. This may not be the case with many of the matured economies that exist in the world, including Europe and the US, which are, which do not really have a growth potential left now. While India is still at a very, very nascent stage, and especially this industry wherein, the habit of people going out, eating out, it's coming into their, bloodstream, so to suggest. It was never the case, it used to be very big kitchens and, people having food in a communal way at home. which is now, getting converted to going out, maybe getting food which is closer to homemade, maybe having a communal factor to having your food, which is definitely coming into vogue, but going out and having food. So the consumer story unfolding into the country is definitely suggestive of that early teens to be the EV EBITDA is not really that bad. The moment you look at the food tech sector, that's where the scare starts coming in. There is nothing called EBITDA. I'm sure many of us realize that the word EBITDA is virtually absent out there. So it's basically on the basis of an EV, and you're talking about crazy multiples. So that is something that one has to be wary of. Food manufacturing, unfortunately, in the country is not really giving you many options to invest. You have money available to invest, but you do not have companies available to be invested in. This sector is definitely bound to maybe come up in the next 5 years as one of the major thrust areas where the investment would go, because this is more predictable than the other two sectors. So that's what my take would be.
And I think one of the statistics you're seeing in countries like the US, where 50% of grocery is now consumed out of home, which means people are eating 50% of the food consumption is out of home consumption. They are eating in restaurants, on the go, on the move. And that's really, I think India is still far from that, but it's a very important trend that's going to.
So if you look at what you just mentioned, that's a very important statistics. So if you go to US today, whether it's your fruits or whether it's your vegetables, the maximum amount of waste which is coming from the trees up to your homes is 4%. So if you're consuming 30%, the balance gets processed. In India, that is 42%. So which is the food wasted into the country. So this processing industry has got to come up in a big way, because it does not really has barriers. You could, export it.
And I think on the flip side, in the Western economies, you see a lot of wastage at home. So out of the refrigerator, food goes into garbage in a big way, and that can be a big number. So I'll just jump into just into Raghav. What is your view on in terms of valuations? I mean, you are the recipient of that. Yeah. So you are happy where things are today? You think that business is undervalued, or what is your view? How's it going to be in the next 1 or 2 years?
I think I think the point that Pramod made was very important. That when you talk about the food and beverage as a restaurant industry or QSR industry, it's the reach of what kind of scale you can get to. It's very limited by how many locations you can be in. Which is why we always talk about EBITDA multiples or your revenue multiple is also a stretch, right? But when you talk about food tech, so something that we're doing is we are now very actively focusing on on-demand delivery of chai. So that's been an interesting thing, because that gives me the reach to target any corporate office. It allows me to target a Lajpat Nagar market where I might not want to open a full-fledged store, and like the EBITDA economics might not work out. But if I set up a delivery hub there, then
you should take over some of these radies and these guys around the corners and actually brand them. Yeah? It's a good option to because they are around the right locations. They're always in the right place, serving you chai which may not be of the best quality. Maybe take those guys over.
Yeah. So at the end of the day, it's about. I think valuation is a function of the reach and distribution that you can finally build, and the scale that you can get to, and I think that's where a company that is not dependent on a physical real estate location is definitely able to do better.
And that ties into what Hemendra was saying in terms of 50%,
in terms of home delivery as well.
Being home delivery, etc.